Good morning, folks, and welcome to another episode with Felix Frey. Today, we're going to go ahead and talk about how and when to trade straddles and strangles. You know, Felix, that was a topic, but I know you and I talked, and I think the folks wanted to talk about directionally trading. So we'll talk a little bit about both. Looks like someone forgot to just change the topic in a time. But I promise, folks, we're going to go ahead and talk about a couple of things here. But Felix, as I go ahead and bring up the disclaimer, what are your thoughts on the market as a whole at the moment?
It just goes up. It just goes up. Uh, I think things are a little bit long in the tooth here, and they're trying to find the next sector. So I think the Chinese stocks are doing all right today, like Baba and Baidu, but it's a game of just trying to find the next hot sector that people are going to rotate their money to.
Yeah.
And I have this range in the SPY at right around here actually. So 762 to 765, right around that range, where you would have this reverse triangle from the bottom, right? So you went down, straight up, and then you broke the triangle to the upside, and we've gone straight up, and that it's about 66 points from the March swing down to April, then all the way back up. So yeah,
Yeah.
you could see that right there. So look at that high. Where's that previous high? Not where we are now.
This
Yeah,
one
right
here,
there. What should be
that
around
is at about
690, 698, something.
this one. No, this one's at 749.
Oh, so where are you? Go back a little bit. Go back a little bit.
I'll go a
We
little
gotta go
further.
back. Yeah, yeah. Go back. Keep going. Yeah, there we go. Okay, so see that high over there is like
Yeah, so this
698 or
is around
something,
695. Yes.
695, and then you go to the low, that
Yep.
triangle. So you see that low right there,
629.
628.
Yeah.
628. So it's about 67 points, right? So
Hmm.
67 points. Yeah. And then reverse
Yep.
that. 67 plus 698 is about
Oh,
695 is 762. That's where we are.
right around there. Yeah.
Yeah. So
So
I'm
that's
I'm
why I should
looking,
call grandma and go short. Got it.
yeah, so I'm kind of looking at that and saying, all right, we're kind of at that spot.
Hmm.
Now, by the way, I thought about that number when we were all the way lower. No idea. No way in my mind thinking, nah, that can't happen. And sure enough, it happened.
Yeah, I mean, people are talking about SPY 800s and all this other stuff by the end of the
Yeah,
year, which
yeah.
yeah, one of the biggest lessons I've learned, a tough lesson I've learned, is just because something has gone lower. So something just because something has been killed and gone low does not mean it cannot go lower. And just because something has continued to rise does not mean that it will
Oh, yeah.
not continue to rise. That's something I've learned the hard way. But okay, I want to, folks, again, if you were here for the straddle and strangle, I do apologize for the mistake. But we are going to go ahead and talk about directional trading, especially with a couple of scenarios that I have. Right, one of these could be let's just take this for example. I want to be very
Sure.
clear, folks. We are not here to tell you to buy anything. We are not here to tell you to sell anything. This is just looking at a scenario and mapping out, if we were to, how we would trade this. So, this is not a trade idea in any way, shape, or form. Let's take a look at this SPY, right? Felix, you have this. Let's say if I believe that this is kind of like being tested as a resistance on the SPY and it's going to go ahead and fail. And we can also talk about if I feel like it's going to break out, how
Sure.
one
Either
would
way.
go ahead and trade directionally. So let's go ahead and say if I believe this is resistance, what steps would you take to go ahead and go short via options and directionally trade this?
Sure. So we're gonna look at just simply buying a call and buy a put. We could talk about the upside and the downside.
Yeah.
And the first thing that you need to understand with directional trading is the need for a target. Where do you think the stock is going? Okay, it's very important in options. It's not just about stock. I think it's going up. I think it's going down. Maybe a point or two. Options is very specific because you have to pay a premium up front to get in the game, and that premium has some embedded expectation in it. So you're paying for something that the market is saying, well, we're kind of pricing in what possibly could happen. And so they'll give you the market price, you'll get the market price, and then you got to figure out whether that's good enough, cheap enough to buy versus your view. It's basically the idea. So you need a target, okay? But what I'd like to do first is, because I think the industry is taught options a certain way, and if you have, do you have the options chain up? Do you have your options chain? Why don't we
I,
go to your options chain? Do you have
okay,
the TradeZero one up?
I do. Give me 1 second. I'll pull that up right here. Okay, I've
Yeah.
got the
So
options.
let's look at this is a standard options chain. Okay, it's
Yep.
no different than any other options chain out there. They're all
Hmm.
pretty much the same. Some have a little bit more here and there, whatever. But you have price, strikes, you have expirations on the top. Okay, everything is exactly the way it should be.
Yep.
Okay, now the question becomes, okay, well, what do I do? What do I do with this information? Where do I buy? Which one do I buy? How do I buy? Right? And
Hmm.
this is where the confusion starts. Okay, and what I'd like to say is that up front, believe it or not, the industry has never really given you a process to buy an option, which is incredible. I mean, they will go through. You can look at the top ranking Google search. How do you choose? And you can go through that analysis, and they will go through implied volatility analysis. They'll say, you got to look at this, you got to look at that. You'll have people say you got to look at the Greeks, you got to look at this, but they'll never tell you exactly how. How do I do that? How do I actually get to an answer? So I know delta or I know gamma or, but how do I use that to actually get to the answer? And I want people to appreciate that when you get here, the reason why it's confusing is because there's never been an answer. Okay. And I spent literally 20 years and throughout my career trying to figure out this answer and eventually got it only because I went to sit next to two big hedge fund guys, big guys in the business, and they were doing something very different. And so I'll show you that process. I'll explain it to you, but it does take it's going to take something else to actually to
Yeah.
do it. So they care about certainty, right? In this game, if you look at this game, it's a probability game. Okay, options are a probability game. There's embedded probabilities in all these prices here, whether you know that or not. There is, right? The market is assuming some expectation of price movement, and they're pricing it into that premium that you see on the board. Okay, if they thought that the S&P was going to be more volatile, guess what? The prices are going to go up. If they thought the S&P was going to be less volatile, then they say, oh, the prices could stay muted. All right, so there is embedded probability in these things. And what happens in the probability game is you don't want to guess so much, right? So I always tell people, so what do you know about the Greeks? Oh, the delta, there's 5 different Greeks. Are you going to guess on all those Greeks? Every guess makes it increasingly, exponentially more likely that you will be right on all the guesses in whole. And so the top guys in the world, they base things on fact. Okay, fact number 1. If I buy this option right now, it's worth whatever it is on the screen. It doesn't matter what some model is going to tell me it's worth. It doesn't matter what, some guru is going to tell me it's worth. It doesn't matter what Felix is going to tell me it's worth. Right now, it's whatever I can pay for it. That's what it's worth. Okay.
Yeah.
So you have to really appreciate that. Okay. So that's number 1. Fact. Fact number 2 is I have some target. That's my target, personal to me. And I know what the option will be worth at expiration at my target. That's called parity. So if you buy the 760 calls for, what do they cost there? 760
Call
calls
it
or
$5.
$5 for what date?
June 9th. So about 7 days out.
Okay, so a week, $5. So I know that if I think my target is 680, right? In the next week, it's going to rip for whatever reason. Then I know as a fact that that option on the 9th at expiration will be worth $20.
$20. Yeah.
Okay? That's a fact. We're not going to change that. So fact number 1, I know what the premium is worth. Fact number 2, I know what it's going to be worth at expiration if my target is hit. Interestingly enough, that if my target is hit in 2 days or 3 days, guess how much it's going to be worth? About $20, $20 plus a couple of pennies here and there, right? So at the end of the day, how much is understanding the Greeks going to matter to me if my target is hit at 780 in the next week? Not much, a couple of pennies maximum, right? Because it's going to all go towards parity. So people need to appreciate that that's how they think. Okay, now they have fact, I pay for this, fact, I know it's worth this at my target. Okay, now I get this relationship between what I'm paying and what I can make. So I can pay $5, I can make 15, it's going to be worth 20, I can make 15, so that's 3 to 1. Now 3 to 1 can be turned into a probability, or you could just stick with 3 to 1. right? And I guess the point is that I'm trying to give you an idea of their mindset. No Greeks. I haven't talked about Delta. I haven't talked about anything. I'm just talking about risk reward. Okay. And so they bypass a lot of this guessing, a lot of what the industry and all these concepts that the industry puts on you and says, and they say, you know what? I don't really care about that because I'm not playing options. Their mind frame, okay, their mindset is I'm not playing options unless I can make good money multiple times of what I pay. So, for
Yeah.
example, if I'm going to pay $5 for this option, I'm not buying that option if because you told me it could be worth 7 or it can be worth 8. That's not why I'm doing it. And I
Mhm.
won't even pay attention to what you have to tell me. If you say buy this option for 5, you can sell it at 7. That's not the way they think. I know day traders might think that, and that's fun to think about it that way and play the next move, but it's not the way these guys think. And it's important. Again, very important to appreciate when they look at this board, they're looking for multiples of what they're seeing.
Yeah.
Okay, in order to play the game. So this is the exact spot where there's a lot of confusion. Now, let's go to the so we don't know how to do it. We don't have enough
So,
information here. Go
so
ahead.
I will say this, right? 3 to 1 is 75%, 25%. So, but
Correct.
going back to what you were saying, there's again, this is just for easy math and ideas, examples rather. There's a 25% chance that comes the 9th of June, the stock will be at, or the ticker will be at 780. That's 25%, 3 to 1. That's what they're paying you for. However, if you believe, and if the models and whatever else believes that, hey, it's not a 25% chance, it's a 35% chance, that 10% discrepancy is your plus EV. And if
That
folks
would
who,
be like an edge, yeah. But you got to
yeah,
be
that's
careful
right.
because I can make it anything, right? I could say 790 and then it would be a different probability. But you're right in what you're calculating. You're saying it's 3 to
Yeah,
1 and it is 25, 75%. The point is though that what we're looking at, if we're looking at the 750 calls for next week with the market right here at around 760, with the market right around 760, it's about a 50% delta approximately. Okay. And so the market is saying, yeah, 50-50, and you think you could make 3 to 1. Well, yeah, well, all of a sudden that sounds pretty good, right? The
yeah,
market's got a 50-50 look at this, and you're saying I think I can make 3 to 1. Yeah, that sounds really good. Now the question is, how good is that target? How sure are you on that target? Because that's where it really matters. You could say any number and come up with anything and get a better look at what the market is saying. So this is where the confusion is. So let's go to the new options chain. We type in SPY. Let's type in what is it, June 9th that you had?
June 9th. Yep. Target
Okay,
was,
so let the board's gonna click pop open.
yeah.
Okay, and let's just look at what the 760s say right there. The 760s are saying what under the price? It's gonna be, you tell me here. Let's
Here, should I need to select a target yet or no?
no, don't select the target. Where's the 760 price there? It's about
Right now,
480 ish.
480, yes.
Okay, perfect. Okay, so now well, let's look at the RR dollar column. So the RR dollar column is essentially saying that is the risk reward break even price that the market is pricing in. This is the market's expectation. So if you look at the 760 call, 769.46, that is the market's expectation. It's basically saying, hey, look, we're pricing in 769.46 on next whatever that is on the 9th, right? Next Tuesday. And let's look at sort of what that implies. Look at how much if the stock was 769.46, if the SPY was 769.46, how much would that option be worth? $9.46,
Yeah, yeah.
right? 946. Okay. 946 would mean you would make how much if you paid 480?
Make about $5 less than. Make
About
about
five
four.
bucks,
Yeah,
right? About $5. $4. 946 is $4.66. Okay,
yeah,
466, which is almost double 480, almost double, which is 50-50, right? So you see how that worked? So
yeah.
saying, hey, look, it's a 50-50 bet. Well, if you're right, well, we're going to price it up about, a
Yeah,
double. And if you're wrong, you're going to lose one, right?
right.
So it's priced correctly. Well, what that RR dollar is doing that same thing across all the different potential strikes. So if you go to the 765s, move up a little bit so people see it. Yeah, 765, 772.22. Okay, why is that number different? People say, how can they have expectations? Because it's different because every option it's like its own game, its own probability game. So you have 765 has a 33% probability of being in the money. That's 1 out of 3, right? 1 out of 3. Okay, so how do you do that? Then you basically would say, okay, well, I'm going to divide 238, divide that by 3, right? And I'm going to say, okay, well, then the option's got to be close to about 7. It's going to be $7.14. 238 times 3, 714. So 714 plus, if the option is worth 714, that's what I'm telling you, the value's got to be 714 plus 765 gets you 772.14. This is a
Yeah.
little bit off on a rounding error on the 33%. You know,
Right.
30, it might be 32.9 or something.
Yeah. Yeah.
So what that RR dollar is basically giving you is this expectation embedded in that price. So for the first time, people could actually see what they're buying, what they're looking at. I'm paying $2.38 for the 765 because the market is pricing in a move to 772.22.
Yeah.
Okay, so you can look at the board and you can look at all the different strikes. Now, instead of thinking in percentages, like I think there's a 35%, what you said, I think there's a 35% chance that it goes here. It's like, how would somebody do that? How would somebody think that? Sure, there are computers now and data and whatnot, and maybe you come up with some fancy number that way. But most people still think in stock prices, in targets. So if we were talking about, I think this thing can go to 780, or maybe we'll look at puts after, I can go to 760, okay, 740. So if I think it can go to 780, let's put in the target in the tool and let's see what it says.
So I've got plus minus, so I can go 5% from here, which is about 800. Oh, I can do custom. Okay, there you go. So
Yeah, custom. Yeah,
7,
do 780. Yeah, there you go.
okay, done.
Give it a second. There you go. Okay, now it pops up. Look, all the way at 773. It's basically saying that's the one you should choose. Okay, but what it's telling you, look up at the top. You see it says this is not typical area where hedge funds buy.
Right.
Right? See more. So what's basically saying, like you've priced in an extreme move, or a very high conviction. So while the leverage may appear attractive, there's little room for error between the probability of reaching your target and the option finishing your money at expiration. It's essentially saying, are you sure 780 in the next week? Like that's what it's trying to say. It's trying to slow you down. The
Yeah.
idea here is that the zone, I call it the hedge fund zone, is the unshaded area right there. That's kind of where you want to be. What you've picked is, or what the machine picked on your view is basically way outside that box. So it
Yeah.
should give you some clue to say, hey, are you really sure about 780? That's really high. If you are, it's not a problem. It's not a problem. Then you can go for the leverage. But the point is that it's trying to slow you down and it's trying to say, are you sure? Because it's pretty far out. Whenever you're so far away from the market's expectation, either you know something that nobody else knows, or it's and part of it, that's the game. But essentially that's what it's doing. So you what I would say here is, I would say, and let's go back to the inputs here for a second. So 780, the next level is confidence, right? I have 8 there. So high conviction trades, hedge funds, you have the hedge fund zone, you have some price, some target, and hedge funds will only use options when their confidence level is high. So otherwise they'll just use the stock. They'll get long stock. So they're really reserving options for these high conviction type of trades where they have this sense of where the stock could be. In this case, I would use I don't really come to the board. I don't come to the board with, what's the options market saying, and let's see if I can beat it. I usually go to a chart first. So now we can go back to the chart and let's say, what's a realistic view of this stock or where this can go over the next, week, and that's what I'm going to start looking at. Right. So right now we have, right. I'll go back here and I'll say, okay, let's pull it back a little bit for the last few days. Right. There we go. Okay. So now too far. Yeah. Because we're just looking now over the next week. Right.
Okay.
And I'm saying, okay. So right now we're at, that low right there, 748, right? 748 on the 27th, 28th, 29th, right? That low, and 754. And then it went up, and that was $6. And then it went up another it's up another $6 to 760. You
712
got
right
this
here.
$12 move here. So, can it get to 772? It's like, that's kind of what I'd be thinking. I'd be looking at that. Now, I do some more some more work. I told you 766. I think that's where I'm a little concerned. But this thing can have a blow off top right here on intraday 772 on some sort of maybe an announcement with Iran, a real concrete announcement. And so let's use 772 as that's $12, up from to 760 to another $12. So 772. Now let's go back to the options chain. I got my level where I think it can go, and let's plug in 772 on the options chain.
So 772. Got
Yeah,
it.
and now let's see what happens. Okay, now it's pointing to the 763 calls. Okay, and I'm looking at this and going, okay, interesting. The range, 772, 774. So let me just plug in 774. Where the just to take a look at what it says at 774. Might move up one. Oh, it actually moves up a few. So the difference between 772 and 774 gives you a decent move on the strike. Okay. But 774, I'm not as confident. So let's move the confidence level down to 7. Right? I'm not going to be as confident there. So now we move back to 7 and we get to 764. Okay. So the higher you start moving in your target, you might want to say, okay, I'm going to pull this back. Or you can do a more concrete level, 772, and keep it at 8, which would have gotten you 763. So this is how you play around with the board. And what I see here is, let's take a look now at the output. The output is basically 764. Okay. My edge, look at the edge there, column, 31%. 31%, and my max percentage payout is 258. So what is let's start with the max percentage payout. The max percentage payout is very simple calculation. It basically says with 774 as your target, this is the max payout at expiration. This is what it's going to be worth at expiration. So it goes to the 759 to the 770 strikes, and all it says is at 774 on expiration, what is the 764 going to be worth, right? It's going to be worth $20. What did I pay for it? Less than 279. I'm going to calculate that percent. How much do I make? Right? Yeah. Simple. Edge is a little bit more involved, right? But essentially what it's doing is it's saying, well, what's my price? What's my target stock price? 774, right? Look at the RR dollar, 771.62. We're above that. We're above that. That's good. The RR dollar is going to be like an over-under. Right? Yeah. If you think it's over the RR dollar, the risk reward break even price, well, that's cheap. If it's below, it's too expensive for you. So here, 774 is cheap, right? How cheap? That's what the OMS, the options margin of safety, the next column calculates quickly for you. It says you're $2.38 above 771.62. Okay, 771.62. Okay, so if you're $2.38 above 762, the question is that good? That's your margin, right? It's like a margin of safety concept with Warren Buffett. So now if you take 238, you have to turn that into a percentage. And ultimately, that percentage is what we call edge percentage. So that 238 translates to 31% edge. Now, what does that mean? That means if you were going to put $1,000 on this trade, $1,000 on this trade, then you could expect to make $310 with that type of trade. You're trying to do these trades with positive EV to your target consistently. And if you do that and you're good at it all, by the way, people might get it right now and say, well, then it all depends on your target. And that is the right answer. The answer is the work has to be done on the target. Let the machine do whatever it needs to do, the calculations quickly, but the work has to be done on where you think the stock is going. Okay. And that's where people fail because they think the answer is in the option. The option is just the reflection of what you think is going to happen, and it's going to give those odds. By you saying 774, you're essentially changing the board. You're changing the probabilities in space and saying, no, I think this is wrong. I think 774 is right. And if I think 774 is the better answer, then what's the strike I should use? That's what we're solving for. Okay. We're solving for that. Does that make sense?
It makes perfect sense. And I like this way of thinking. It's a way of thinking that I haven't had before. Full disclosures, because I like to degenerately get into options. It's awful, but which is why you're there and I'm here. But yes, this is a great way of looking at it, and it does help individuals also not get into an options contract. Stock moves in their direction, but not enough in their direction. And
exactly. That's exactly the point. Exactly. You don't have to worry about that anymore. At this point, you're risk managing the option as it goes, but you don't have to worry about that. Oh, the IV crush doesn't matter. If you're buying something because you think it's going here, the IV crush is going to be part of the life of that option. But if
Yeah.
you're right, the IV crush is not going to matter at all. I just told you it can't. Fact, you get to where you need to go. The option is worth what you thought it was going to be. Doesn't matter what IV crush does. Doesn't matter about what the IV was, what it will be. It doesn't matter. Okay.
Yeah.
And that's why I say the Greeks won't matter if you do it this way. And this is why the top guys in the world do it this way, because they don't have to think about that stuff. They have
Yeah.
to pick a certain expiration. How do you do that? Well, you got to figure out how long it will take for your idea to pan out. What will it take? What's the event? Earnings, product announcement, FDA, all of that. And so this is a new way of thinking. By the way, if you have poker players in the room, this is not any different than how people play poker. You have a
Yeah.
pot, you have the odds coming from the deck, you have a pot that you can play, and you have the amount you have to put in the pot to pay in order to potentially win a bigger pot. Do you have everything set for you in as far as factual answers? No, but right now you do. You know that the pot is worth X and my payment is Y, but the pot could be a lot bigger. Okay. And so these are the things. This is very similar to poker mentality, poker thinking. And by the way, what I've brought in with our dollar edge percentage. Edge is a concept. Mathematical edge is a concept. It's been around for 300 years. And the reason the top guys in the world use this is because it works. And one, it works. Two, it's the only way to win at a probability game. Mathematical edge. It's the only way. Heads or tails, backgammon, any of those games.
I appreciate it. Always a great way to kind of take a look at it in terms of probability, percentage, find your edge. And it starts, as always, on the charts and where you believe it might go. And then you kind of work your way backwards. Felix, always a pleasure. Thank you so much for your time.
Take care. Bye.
Take care, folks. Bye-bye.